Pathway to Success, the course aimed at building a thriving mindset and providing essential tools for achieving your goals in personal finance, presented by the professionals at KVR Team. This course is designed by a financial professional. However, it is meant to be used as an educational resource only. It includes vital information about very critical factors which can determine our level of failure or success in reaching financial goals. It also provides tools and strategies that can help you put money to work instead of always working for money. The following information is not intended to be considered as accounting, investment, tax, legal, or financial advice and should not be taken as such for any particular individual. Please consult with a licensed professional for specialized advice and to build your financial plan. College planning and funding, retirement accounts, and tax advantages of business ownership. According to Investopedia, it costs an average of $234,000 to raise a child to age 18. Many parents take on the task of paying for college as well. There are a number of ways to pay for college, starting with scholarships and grants. Then there are loans, of course. One strategy in using loans is that we can use them for college expenses and let the money that would be paid directly from our own resources for tuition continue to grow and avoid interest charges by paying off those loans right after our student graduates. This lets us keep more of our money growing during all of the years that college is being attended if we are using a correctly designed tax-advantaged account. Like with all plans, the sooner we develop our strategy to get a certain goal or outcome, the more opportunities we will have time to take advantage of. If we put aside a portion of what we spend on our children while we raise them, we can be better prepared for college costs. Part of college planning is knowing how much we can expect college to cost in the future. Another part of college planning is knowing whether the degree in our area of interest has a real market value. Can it truly be an advantage for your child in their chosen field? The more specific a student can be with what they want to do for a career, the more effective college can be. The college attended should be well regarded for the major chosen, with not only the degree offered, but also in the ability to provide access to networking opportunities. How is the plan affected if your student changes majors? Another way to be more cost-effective in college planning is to narrow your college choices to 3 schools. According to a recent U.S. News and World Report survey of 600 universities, they each make from $3 to $5 million every year from rejected applications. That is free money for colleges, most of which could have been held on to by parents. Another way to lower costs is to attend a 2-year junior college and then transfer to the chosen 4-year school that matches up with it. Last, but surely not least, having personal mentors and advisors who can help with financial aid admissions, the course selection, and a fitting campus environment can give us an edge in our college quest. There are a number of well-positioned college planning programs that are available to aid in all aspects of higher educational pursuits. These organizations can save us both time and money, starting with timely and error-free submission of financial aid and admissions forms. Below is some information on college funding strategies to go along with your planning. 529 plans. In a 529 plan, parents put after-tax money into an account with investment growth potential. The growth is tax-free, and the money can be taken out tax-free when used for college expenses. It can be transferred to any child if not used by the first. If it's not used for college at all, it's taxed at regular income, plus 10% on the growth in the account. Remember, 529 plans are counted as part of the student's expected family contribution when the government reviews a financial aid packet. We may also be able to provide a significant portion of college expenses by utilizing the infinite banking concept. This requires advanced planning and the required amount of contribution to an account that will result in maximum growth potential. The infinite banking concept can also be used without it counting against the expected family contribution calculated in the financial aid a student may receive. Retirement accounts. What are they not telling you? One of the most widespread types of retirement accounts include those that require an employee or worker to contribute a portion of their own earnings that they will later use to live on once they stop working. They have replaced defined benefit plans, which used to be offered to people, known as pensions. One of the most popular designations for the newer, defined contribution plans are 401ks. The term 401k comes from the location in the IRS tax code where the rules about this type of plan are laid out. According to Bankrate.com, as of the third quarter of 2023, the average American has $107,000 in their 401k account. Companies often lower their share of the tax liability by writing off the cost of setting up a 401k. However, the investment firms that handle these accounts pass additional fees on to the employees, which are deducted from their paychecks. Below is some information from the U.S. Department of Labor's data on 401k fees. Assume that you are an employee with 35 years until retirement and a current 401k account balance of $25,000. If returns on investment in your account over the next 35 years average 7%, then fees and expenses reduce those gains by 0.5%. Your account balance will grow to $227,000 at traditional retirement age, even if there are no more contributions to your account. If fees and expenses are 1.5%, however, your account balance will grow to only $163,000. The 1% difference in fees and expenses would reduce your account balance at retirement by $64,000. In this example, there is a significant loss of value in the account with just 1% in additional fees. After that, taxes can eat up almost half of what's left. There are three main fees for these type of plans. They are plan administration fees, investment fees, and individual service fees. If you have a 401k plan, please check your statement to find out which fees you are paying and your options to reduce or eliminate them. We must pay attention to what our plan is invested in. We also have to make sure we know how much to expect to have by the time we decide to retire. These plans are most often exposed to how the stock market performs. Our belief is that someone should not have all the money they want to access during their retirement in this type of account. Individual retirement accounts. The traditional IRA is similar to a 401k in that it is a tax-later retirement account. The main difference is that you start and fund it without the assistance of an employer. The only requirement is that you have what is called earned income. However, there are some restrictions in order to qualify for the tax-later features it offers. If you are participating in a retirement plan at a job, your income must be below a certain amount to have a separate traditional IRA. Another type of IRA is called a Roth. It is named after the late Senator William V. Roth, who helped get it signed into law. You save in this account using money that you have already paid taxes on. You don't get any current tax benefits in this type of account. What you do get is the chance to receive tax-free growth on your money if you meet two conditions. 1. You let the gains of your money sit for at least 5 years after you first contributed. 2. You reach age 59 and a half with exceptions for passing away or being disabled. You can also leave this money in your account for as long as you want. However, the IRS doesn't allow us to save as much in a Roth IRA as a traditional IRA or 401k. There are some income limits you can't go above. To contribute to a Roth IRA for the 2024 tax year, as a single person, your adjusted gross income must be under $161,000 and under $240,000 if you are married and filing taxes jointly. Other types of IRAs include the following. A simple IRA. This stands for Savings Incentive Match Plan for Employees. It's mainly for small businesses and self-employed people. The contributions reduce your current taxes and can grow tax later until withdrawn. Employers must make contributions whether employees contribute or not. SEP IRA. This stands for Simplified Employee Pension. Here, only the employer, often the person who owns the business, makes contributions for all the people in the business. The same 59.5 and 70.5 age rules apply. Rollovers and transfers. A rollover is moving your money from one account to another. It could be from an IRA to another IRA or a different type of investment account. If you take a bit of time to research your options, there are some very favorable things you can do with rollovers. You can move your savings from an account that can take losses in the market to one that protects your money while it grows. There is also a type of rollover called a backdoor Roth IRA. Here, you are basically sidestepping the Roth IRA income limits by taking money in a traditional IRA and transferring it to a Roth. You must then pay taxes at current rates. But then it grows tax-free from that point. This involves some paperwork and the know-how of qualified professionals. Our belief is that it is less than ideal to depend only on IRA accounts if your goal is to become financially free. This is because here a person is dependent on the account lasting as long as they live at a level which allows them to keep their current standard of living. These type of accounts rarely, if ever, achieve that goal for most individuals because there simply isn't enough in the account to make that happen. The tax benefits of business ownership. The U.S. tax code hits the traditional employee the hardest. Those who are financially independent understand that a major factor in reaching their goals is reducing taxes. Those who become business owners and offer a product or a service can reduce their taxable income by a considerable amount. This can let you save more and use that money for the growth of your business and for your future. The proper tax professionals should be consulted for more details on this. Make sure to look at the entire picture of business ownership. There is much more work in becoming a successful business owner than there will ever be in working at a job for someone else. The question is, what kind of life do you want for yourself and your family? Do you want to be financially free? If so, being a business owner in America is without question one of the best paths you can pursue. You can start one without leaving your job. Your first goal should be to create income that matches what you are already making. Then you can leave the job behind for the future you want. Once you find a service or product you want to offer, you can start as a sole proprietor, then scale up and get into the best business structure for you as you learn and grow. Starting a business is a serious commitment, and it generally takes a number of years to establish a solid footing. The survival statistics for business startups are not good. We believe the main reason for the high failure rate is that people enter business ownership thinking like an employee, and they do not change this way of thinking. One of the most important things to remember about business ownership is that you are the owner. You must be prepared for the constant effort that will be necessary for your business to become self-sustaining and successful. Often it requires many more hours of work to build than people anticipate. Please talk with business owners in the field you want to be in. There's a lot of information you can get from others to help develop a plan. As always, consult with a tax and financial professional who will agree to communicate with each other to give you advice for your business needs and goals. Tax advisors are concerned with your past. Financial planners are concerned with your future. A balance must be reached in this process between them as you work towards financial independence. Also, something you should consider when addressing the needs of your business is key person insurance. Coverage should always be on your mind. First for you and your family, then for your business. It is a must. Key person coverage can create tax deductions for the premiums you pay, provide money for the business if anything happens to important people, and cover them with chronic and critical illness protection. There is also the added benefit of the tax-advantaged cash value that can be built up inside of index policies. Thank you for watching our educational video. For questions or more information, contact us at kvrteam.com.